Everyone. I'm Steve Carlson. I work here with Practical Farmers of Iowa. Thanks for joining us on tonight's Farminar. I'm going to go ahead and get started here. It's about 7 o'clock and we have a lot of information to cover. So as you can see, we ask people to put their email address and their location in the chat box here. We use that for grant reporting and evaluation. So if you haven't already, please do that. Tonight's Farminar topic is getting started with farm financials, and I've got Paul Quam here in the house with me, and he's got a few dozen years experience with agricultural finance, so a great person for this topic. Paul's been all over the place, from operating a soybean seed company to serving as an agricultural loan officer to being the CEO of a community bank, and he now runs Quam and Associates out of Jefferson, Iowa, offering financial services to a wide range of farms and companies. And Paul's been very generous with Practical Farmers of Iowa by helping our beginning farmers work on their business plans, and we're glad to have him here tonight as well. So after I do a little intro here about Practical Farmers of Iowa, Paul's going to talk about some basic farm financials, and then he's going to discuss how to use those financials to secure farm financing. And then we'll have plenty of time for questions tonight. So we do these just about every Tuesday night during the fall and winter months, and next week, on March 8th is the last of this winter period, and that's on neonicotinoid seed treatments. All of these Farminars are recorded, and we put them in our archive. There's a link to the archive right there, and we have just over 100 Farminars now archived, so tons of topics in there for you to dig through. And if you're not familiar, PFI was started back in 1985, and we are a nonprofit organization made up of farmers and friends of farmers, and our farmers come from farms of all sizes, farms of all enterprises and shapes and sizes, and from all over the state and far beyond Iowa as well. We have members all over the country. So our mission statement at Practical Farmers of Iowa is to strengthen farms and communities through farmer-led investigation and information sharing. And we use this mission to help farmers practice an agriculture that benefits the land and the people. Our values at PFI are welcoming everyone, creativity, collaboration, and community, viable farms now and for future generations, and stewardship and ecology. As I mentioned, we are a member-based organization, so if you're not already a member of Practical Farmers of Iowa, you should consider joining us. Membership allows you to tap into our network of members, get on a ton of great discussion lists, you get our newsletters, discounts to our events, and you get the opportunity to participate in PFI research projects and all of our programming. You can get a lot more information about joining Practical Farmers of Iowa on our website. There's a link right there. So this time of year, it's maybe the off season, but we still have a lot of events on our event calendar, a lot of PFI and non-PFI events. So check out the events on our event calendar to help further your farm education this off season. And a couple of housekeeping things real quick. Looks like everybody's using the chat box with their information there. That's great. Also, down in that very lower left-hand corner of your screen, we have a poll that we'd like you to use. Go ahead and tell us how many people are watching from your connection there. That, again, helps us report to our funding agencies as to how many people watch these things. So I hope to save plenty of time tonight for questions, so be thinking of those as you go along. And in regards to questions, it works best if you save your questions until Paul is through. Unless it pertains to the slide that we're on. So clarifying questions are encouraged, but let's just try and not jump around on topics too much because we will have plenty of time to go through questions once Paul's finished. So now I'm going to pull up his slides right here and let Paul take it away.
Thank you, Steve. I appreciate the opportunity to spend time with all of you this evening, and I especially want to thank Steve. He helped put this PowerPoint together and has been very helpful, and he is taking care of all the technical aspects, and for an old man, that's very reassuring. In the past, I've covered a lot of this material as a 6-hour seminar, so quite frankly, in the next 45 minutes, we are going to really highlight the high points and move rather quickly. And as much as anything, hopefully, in this process, we'll give you some sense of direction as to where to start. As we jump into this evening, once I figure out how to run this mouse, we are going to deal essentially with two parts of what typically might be your business plan. And those two parts are the accounting and the finance function. And then I'll throw in some additional thoughts on the tail end of the presentation. But oftentimes people don't recognize that accounting and finance are two totally different disciplines. And so we might give a little bit of quick consideration as to how they differ. First of all, as regards accounting, accounting deals with the gathering of the information. And in particular, here in a couple of minutes, we'll look at the various parts of the accounting function, the balance sheet, the cash flow projection, a profit and loss statement. And there are certainly other documents that can be generated under this. But essentially, accounting deals with gathering information. So who's going to be responsible for gathering it? How often are we going to gather it? Are we going to gather it in the field? Is it going to be a manual system, a computerized system? Is it going to be in-house, out-house, etc.? Finance then, in turn, deals with all this information once we've pulled it together. So under finance, we look at doing cash flow projections and projecting profit and loss, and look at other items that we won't be necessarily handling tonight, but items such as tax planning, deciding whether we want fixed rates, variable rates, whether we want long-term interest or long-term loans, short-term loans, or a mix thereof, etc. So that gives you a little bit of insight into how we intend to progress here this evening. Also, I might say that many times the terminology gets confusing, and people will say financial statements, and financial statements can cover a whole multiple of things. But tonight we'll try and focus our thoughts here as we move forward. First of all, beginning with the balance sheet. And the best way to think of a balance sheet is it's being a snapshot as opposed to a movie. A balance sheet is only good at a given point in time. It's different the day prior and the day after for no other reason the accrual of interest. And typically, in particular where ag is involved, we break the balance sheet into three sections: the current section, the intermediate section, and the long-term section. And then a couple of things that the balance sheet typically does for us is help us understand where we are at, or define to what degree we are using financial leverage and liquidity. And just briefly, we might describe those a little bit. They may be terms that you're not real familiar with, but financial leverage deals with how much money you're using relative to that portion that's yours as versus someone else's. Liquidity typically deals with the degree of cash you have on hand to meet your immediate needs. And we'll talk a little bit more about liquidity in particular here in a minute. By way of illustration, we mentioned that we break this into three sections. And the first section is the current asset and current liability section. And the typical definition of current assets are those items that in the normal flow of the business will turn to money in the course of 12 months. And in a general sense, they will include cash, accounting, or cash, inventory, and accounts receivable. And I've just thrown up here an example balance sheet, and this one, of course, is very ag-oriented, as you can see. But as you look down through this list of current assets, you can see that over the course of the next 12 months, all of those items should turn to cash in the normal flow of the business. We'll first go down the asset side, or the left-hand side of the balance sheet. And the intermediate assets are somewhat unique to ag balance sheets. In general, a lot of other balance sheets that you may see on businesses won't have an intermediate division. They'll just have short-term and long-term, or current and long-term. But in our intermediate assets, I like to define that as being the items that we use in general to produce what is carried up in the current asset category. So that would be the machinery and equipment that you would use to produce crops, or the breeding stock, for instance, if you were selling feeder stock or feeding out livestock or producing milk, etc. And then long-term assets, as the name may imply, or fixed assets is another term typically used, would most often include all the real estate and the permanent structures, etc. As we move on the right-hand side of the balance sheet, we look at the liabilities. And current liabilities are those liabilities that are going to be due and payable in the next 12 months. And in particular, one of the things that we might note here is that sometimes when people put together a balance sheet, they don't realize that we need to put in the principal portion of long-term loans as a current liability. That principal portion is due even in light of the snapshot, but we will include interest that has accrued to date, but we won't include the interest that will accrue through the course of the rest of the year. And ideally, as we set up debt, we always like to set up our financing across the sheet, as we say. So in other words, if we are buying a piece of machinery, we'd like to set it up over the course of several years as versus 1 year. If we were to set it up in 1 year, then we wouldn't be straight across the sheet. We would have an intermediate asset, but we'd have a short-term liability, and that hinders our liquidity. And we'll talk about a current ratio here down the road just a bit that will help us gain insight into that. As we move on here, Steve has included this piece of material that's available through Practical Farmers. Is that correct, Steve? And it shows here how to accomplish a number of these calculations. And so these materials are available to you through Practical Farmers, and I'd sure encourage you to make use of those. We talked a little bit about leverage, and here's a silly little illustration of leverage that I've used for many years. It's not original with me. It was the brainstorm of another loan officer that I worked with. But you have to use your imagination here. You see a series of tractors pulling a wagon. And in this first case here, we have a scenario where we have a very small tractor pulling a huge wagon. So we have a John Deere Bead pulling a Parker 500 bushel gravity flow wagon. And you'll note that I have percentages. And one of the things that we do when we looked at a balance sheet, and I didn't highlight that, but your net worth is defined by subtracting your total liabilities or obligations from the total assets that you have. And that number reflects your net worth. And then in turn, if we divide that number by the total assets, it will tell us what portion of the business you own. So in this instance, someone's net worth represents 10% of their total assets, or out of every dollar they have, 10 cents are theirs, 90 cents are their creditors. So if we think of your net worth as having to pull around your debt, or your net worth is the tractor, the debt's the wagon, you can see that under optimal conditions that may be possible. But at proves to be risky from a financial perspective in that, as I said, conditions have to be optimal. Yields have to be excellent, markets have to be excellent, weather has to be excellent, et cetera, et cetera. And then it can work if you have very little net worth and high loads of debt. As we move on down the sheet, we have a medium-sized tractor, and maybe it's a 1486 hooked onto the Parker gravity flow. A reasonable combination, but still, if you were not making prudent decisions, you could get in trouble here. And in the last illustration we have a stagger hooked onto a 10 bushel gravity flow, or a small 100 bushel feeder wagon, for example. And the point being here that, you could drag that wagon practically through a river if you were to wish, but it's not the most optimal of use of funds. And so I'm not implying here that it's best to not have any debt. We want to be somewhere probably between these two latter illustrations. Another quick little ditty that I've used over the years that helps us understand leverage is this one. In essence, there are only two places you can get money, your own and someone else's. So here I have two examples, the one on the left representing a young person just getting started, the one on the right being someone who's been established in business for an extended period of time. And here these people are involved in producing, we'll say, sledgehammers. So the young person has two of their own dollars to invest. It costs $10 to produce a sledgehammer, and so they need to borrow $8. In turn, they are able to sell the sledgehammers for $12, so they make $2. And the thing we want to look at here is that they had two of their own dollars invested. They made $2, so they had 100% return on investment as regards their own money. And they had 20% return in terms of total costs. If we step over on the other side, the established person had 8 of their own dollars involved. They borrowed 2. They had the same costs of production. They sold them for the same amount. They realized the same $2 profit. But as we look at the profit as a return on their own money, they only realized a 25% return, or 1/4. And so as you look at this, you might say, well, we should feel sorry for all these people that are well established because they aren't getting much of a return on their money. We're far better off as a young party just getting started. Well, before we feel too sorry for them, let's look at what happens in a down market. Same example, only this year, rather than being able to sell sledgehammers for $8, we can only get for $12, we can only get $8, so we lose $2. So now the young person who only had 2 of their own dollars has lost 100% of their investment. As we look at the established person, they've only lost 2 of their dollars, so they still have a 60% equity position versus 80, and so they're still in business. And the point that we want to remember here, and this is probably one of the most important points you can remember all night, is that financial leverage cuts both ways equally. It's great when you're profitable, but it puts you out of business very quickly if you aren't profitable. And so it just highlights how extremely important it is on the front end of a business to get started on the right foot and not have a bad several years right out of the box. Moving on to cash flows, and we reference the balance sheet as being a snapshot. A cash flow is a movie. So now we're going to look at the total dollars that come into the business, and this is the important thing to remember here, are dollars in, and on this one sheet, and this is just an example of some proprietary software that I use, but in this one sheet, we have all the places that a dollar can come into your business from. And if we look at these sections, and these will be general to all businesses, the first section is that of ordinary income. And if you're familiar with the Schedule F on a farm return or a Schedule C in a business return, these are the kinds of income items that typically would be reflected there. The next place that we can have a dollar come into the operation from is the sale of a capital asset, or typically something that we would have had in that intermediate section of the balance sheet that we just previously discussed. The third place that we can have dollars come in are from outside the enterprise, off-farm employment or outside employment of some nature. And then the last place that we can have funds come into the operation from would be that of borrowing money, whether it be an operating note or a long-term note, intermediate-term note, etc. So point being, we add up all these sums and we get to the bottom of the page and we have total funds available to us for a given month of X dollars. And so this represents then the first page of our cash flow or our movie. And here are just those categories that we just discussed: ordinary income, sale of capital assets, dollars from outside this enterprise, and dollars borrowed. Now the flip side of that, as one might guess, represents total dollars going out of the business. And so here, again, in this first section, and again, this is an example of some proprietary software that I happen to use, and this is all just set up in an Excel spreadsheet, incidentally, which is a phenomenal tool. But you can see all of this first category then, again, would represent ordinary expense as opposed to ordinary income on the prior slide in terms of using a dollar. The second category that could take a dollar would be that of acquiring a capital asset, that being breeding stock, machinery and equipment, improvements on buildings or ground or real estate of any nature. The next use that we could have for a dollar would be that of paying back principal. And we note here that this just references principal because the interest is indicated up here as an ordinary operating expense. So as we get to the bottom of this page, then we have total cash required. And then by looking at that bottom figure of total cash available from the prior screen, we have a net cash position. And in this particular instance, this software then looks to see if that's positive or negative. If it's positive, it'll add it to our cash balance. If it's negative, it will borrow it on an operating line and go across the page then. And as we fill in all the various months and go across the page, it will project then what our total operating need will be on a month-by-month basis and where the balance for our operating note should be. And that is very useful, obviously, when you go to your lender, because one of the questions they'll have are how many dollars are you going to need at the maximum time frame? When will that time frame be? And at what point will you be able to pay back those dollars?
Paul?
So
So it looks like we have a question here from Karen that she's asking why on this slide here the time period starts in December and ends in November as opposed to maybe, January through December. Is there a reason for that?
There isn't specifically. It just happened to be the time frame that I was looking at in this particular example. One of the things that I would say is that sometimes you will see forms that look at cash flows on just an annual basis. And here we have done this on a monthly basis, and doing it on a monthly basis is very helpful from several perspectives. It does allow us to project when that peak need will be, and in particular with agricultural enterprises, and especially as regards crop enterprises, whether they be vegetables, corn, beans, etc., a number of those months are going to be negative. And so if we've done this cash flow work and we fully understand that each month will be negative for the first 4, 5, 6 months conceivably, then we won't get excited, and hopefully neither will our lender, because we will have projected then that when we get to harvest, obviously, everything comes back into play. And I don't know if that's helpful, but the months here are not, there's no relevance to those. Typically, it's a 12-month period that we look at. Again, we've discussed those, so we could move on to that. Monthly versus cash flow, we've just talked about that. It gives us our checkpoints along the way. By way of example, again, if we had projected that by the third month out we'd be negative $100,000, and when we look at actual versus projection and we're only under 9, even though we're minus $90,000, it's time for a party. So it gives us a measuring stick as we go along. And that is extremely important. So let's move now and talk a little bit about profit and loss statements. And you've perhaps heard the terminology cash or accrual, and we have to decide on which basis we're going to keep this profit and loss statement. And cash basis accounting simply means that we are entering the transaction at the point in time that actual cash is either received or cash is actually spent, versus accrual is when the commitment is made. So in other words, under accrual, once you've made a sale, it may be out there as a receivable, but you would enter it as income at that point in time. And ultimately, to really know where we're at, we need to be involved with accrual accounting. And one of the things that I've not mentioned here to date is that one of the best off-the-shelf accounting packages is Quicken Books. Yeah, there's QuickBooks Pro. There are multiple levels, but it's very reasonably priced, and it has a multiple of menus and screens that will lead you through. And one of the nice things about it is that it's just a matter of selecting a menu as to whether you want to be cash or accrual, and it will make all the appropriate entries for you. Likewise, all these various statements, some of which we're discussing tonight and some that we aren't, are all incorporated into QuickBooks, and it will put the appropriate entries in the appropriate statement and help all of these flow together seamlessly. So it's really something that's quite helpful. One of the things when we talk about a profit and loss statement versus a cash flow that we need to recognize is the item of depreciation. And depreciation is a concept that is often very confusing to a number of people, in that when we get to our tax return in particular, we are allowed to deduct a depreciation number, but we are not allowed to deduct principal payments. And on a profit and loss statement, we list depreciation. In the cash flow, you'll note that we were listing no depreciation, but we were listing the principal payment. And depreciation is listed in our profit and loss and on our tax return as an expense, but it's an expense that we don't have to write a check for. And it's the only expense that we actually don't have to write a check for. So in that regard, it becomes a source of funds. And this is just a general rule of thumb that I like to use. Ideally, I would like to see, if it's possible, to make our principal payment from the amount of depreciation that we are allowing ourselves on our profit and loss statement or in our tax return. And again, that then helps us cover that principal payment, which is not allowed as a tax deduction. Also on depreciation, one of the questions we need to ask ourselves when we do our profit and loss statement is specifically, what's the purpose of this particular profit and loss statement? And by that I mean, are we doing this work to do our tax return, or are we doing this work for internal purposes? And that will then in turn influence how quickly we depreciate assets. The depreciation schedules that are allowed on your tax return are all predetermined by tax regulation. But if we're doing this to look at how profitable we are or our profit and loss situation internally, typically I like to use a depreciation number that reflects the physical using up of the asset, which usually will be a much smaller number than is the case for the tax return. So these are some thoughts that you want to keep in mind there. And then ideally, and I don't happen to, didn't include the sheet here, but on profit and loss statements, we also, to really do them correctly, need to do some accrual adjustments at the end of the year for beginning and ending positions in line items such as accrued interest, accounts receivable, accounts payable, the various inventories, etc. And by way of example here is just a quick profit and loss statement, and this happens to be just one of the standard reports out of QuickBooks again, which I mentioned earlier. And incidentally, QuickBooks is the #1 and most heavily used accounting software in small business, both in the US and internationally. And also, it's handy in that it's very, very user-friendly for people who are non-accountants, but yet when you go to your accountant, all accounting firms typically are able to import all your files and work readily with it to help you with your tax returns. Some quick accounting tips here. Compare your budget to actual and update it as you go. And earlier I said we like to do this by the month. So as each month passes, replace what you projected with the actual, and that will extend through the course of the year then and give you with each passing month, a better idea of how the year has prospect of ending for you. And then the second point that I would make is that as you do, in particular cash flows, you'll become more accurate over time, obviously, because you have history. And Steve, as I recall, one of the things that's really important for those of you who are involved in producing vegetables and fruits, etc., Practical Farmers has some actual numbers. So if you were a startup and you don't have any of your own history, it's my understanding that Practical Farmers has actual numbers from a multiple of producers. Is that the case, Steve?
Yeah, that's right. We just put out this, I'll put it in the chat box here. We put out a research report with, I think, 11, 12, or maybe 13 PFI farms participated in this, providing their farm financials. We compiled all of that and put it into one research report right there. That's a great resource.
That is a fantastic resource because lenders obviously are far more impressed with actual numbers or actual history versus our guesses. And then we will always, as we do projections in particular and cash flow projections, we'll always be more accurate on the dollars out than we are on the income side, even over time. And the simple reason for that is because we have more control over those. Another thing that comes into play from time to time is how long should I do a projection? And at what point should I start? And many times we'll see instances where people will be anticipating adding a new enterprise, and they do a cash flow projection based on it already being fully in place. And that's a mistake. You need to start your projection with the first dollar out. And the analogy here is it's a little bit like charging a pipe with water. If we have a 6-foot pipe and we start pouring water in the top end, it obviously doesn't come out immediately on the other end. And so that represents the use of dollars without any income. And then once we have water coming out the other pipe, as I say, or we have a normal flow of whatever operation we're doing, Typically, I like to go 12 months past that period. And very rarely do I go beyond 3 years. From time to time, I'll have clients say, well, I'd like for you to do a 10-year projection. And I'm happy to do that if they wish, but quite candidly, it's a waste of their funds from the perspective that when we're doing projections, to do year one, we make assumptions. To do year two, we're building assumptions on top of assumptions. To do year three, we're assumptions on top of assumptions on top of assumptions. And mathematically, our accuracy rate is just next to nil at that point. And so you can see that if you compound that out to 10 years, it really has extremely limited value. And then another misconception, oftentimes, especially with startups, is that people say, well, I don't dare go to the bank with a projection that shows a loss position in the first year. And so, they, in essence, work with their numbers to show a profit. And businesses typically are not profitable in the first year just because of this issue, as I discussed earlier, of pouring water in the pipe. And quite frankly, with lenders with any experience at all, it's a red flag to them if you do come in with a cash flow that shows profit the first year, or at any rate, any significant profit. And then another thing that we want to remember is that we don't have to necessarily own assets. We want the use of an asset at the lowest cost. And so that gets into giving consideration to renting, leasing, etc. And then another thing that's extremely important is to understand fixed versus variable costs. And we don't have a lot of time to go into that, but fixed costs are those costs which don't change regardless of the volume in your business. So by way of example, that might be your living expense, that might be property taxes for the year, or insurance, liability insurance as an example. Whether you produce one item or 20 items, those are constant. Variable costs are those costs that are directly associated with producing one more unit of production, whatever that unit of production might be. We'd next like to just briefly touch on enterprise analysis. And again, after we've done our cash flow projections, we have a lot of the inputs for this. And we should end up, when we put together an enterprise analysis spreadsheet, a lot of the line items should come straight from the dollars in and dollars out schedules that we reviewed earlier. And so here, just by way of quick example, I assume that we were producing cucumbers, beets, and muskmelons. And we had a total labor bill of $240, and we needed to allocate it between these three. So I've done that as indicated here. Likewise, we had a total fuel bill of $40. We allocated that, and I just worked with these two items, but obviously you'd have many more. But the point being that you get a total cost then to produce that given item. And if we were to go to our dollars in sheet, we would have had dollars in for cucumbers, dollars in for beets, dollars in for muskmelons, etc. So if we go to that dollars in sheet and look at all the various sources we've cited as potential for income, those become the column headings on this enterprise analysis. If we go to the dollars out, all the various line items there then in turn become our costs that we need to allocate under these various headings that we have for potential income. So we arrive at a total cost for each of these particular items, and we have projected to come up with income, how many units we would produce. So accordingly, we divide our total cost by the units produced, and we arrive at a cost of production. One of the things that's important to recognize here is that from time to time, even in particular in what we think of as being the typical production items here in Iowa with perhaps row crop and livestock, if livestock markets are bad, as an example, a lender might suggest, or or producer may say, well, I think I'll get out of the livestock business. And one of the things that we need to recognize is that, again, thinking in terms of the fixed and variable costs, when we drop out an enterprise, the portion of fixed costs that were associated with that enterprise now have to be switched to one of the other columns of the remaining enterprises, and so those break-evens go up. And the general economic rule then is to continue to produce as long as the variable expenses associated with that given product are covered. And even though all fixed and variable expenses may not be covered, you're still better off to continue to produce as long as you're making some contribution towards those fixed expenses. One of the items that's used to calculate break-even costs is a break-even chart, and Steve has pulled this chart together for us. But here, this purple line you see being the revenue line. So across the bottom here, we would assume that we have units of production. So at the point we have zero production, we have zero income. The more units of production we have, the more dollars we realize, that being the vertical axis. And this flat line here then represents these fixed costs as indicated here. So those are the property taxes, the living expense, et cetera, et cetera. And then again, as with each unit that we produce, the variable costs associated with that unit are represented by this red line. And you can see where the two intersect. That represents our break-even point. And so beyond that point, we are realizing profit that covers both our fixed and our variable expenses. Next, let's quick look at some financial considerations. And we're going to have to really hit these fast. But how many places are there to get money? We mentioned earlier there are only two. Yours or someone else's. If you're picking a bank as a source of money, you can get online. There's a site called Bankrate that will give you, in essence, a report card on banks, or by federal law, FDIC reports are required to be filed quarterly by banks and published in their local paper. So that can give you some insight into the strength of a given bank. Banks, in terms of the monies that are in the bank on deposit, by regulation, they can only do two things with them. They can either buy government-backed bonds or make loans. And again, these reports that I've just told you about will give you some insight into which of the two your bank may favor, or to what degree. What is the nature of your lender? Who are you dealing with in the bank? And by that I mean, is it a small community bank, and perhaps you're dealing with the president of the bank and his family owns the bank? Or are you working with somebody that's one of the junior staff members, and you recognize that they're going to have to get the approval of several other parties before they can make a commitment? So have an awareness of who you're dealing with in the bank. Know how decisions are made. If it's a community bank, are they being made instantly at the desk? And the size of the loan will influence that quite often. If it's a national bank, there may be requirements for it to go through several different layers, and they probably aren't all on location. Bankers are risk adverse. Why is that? We talked some earlier about what the net worth of yourself or your operation on your balance sheet. Banks obviously have a balance sheet, and we often hear about the bank's money. And in reality, banks have very little money. A bank's net worth, or its capital, as it's typically referred to, ranges from 8 to 12%. So in other words, when you buy or borrow a dollar, probably only 8 to 12 cents of that dollar is, quote, the bank's money. The balance of that are the depositor's money. So it's very, very important that they certainly scrutinize the risk before they make a loan. And that leads us to this next point, that it is extremely important for you to have a risk management plan and to share that with them. Some quick other thoughts. To have a successful borrowing relationship, we have to have both cash flow and collateral. And banks, again, have differing philosophies. They may lean more heavily on cash flow versus collateral, and then others are more concerned with collateral. And so, again, you need to try and have a sense of, through discussion, which way your particular lender may lean, and that'll give you some insight into how you approach them. This next concept is one I like to call offensive documentation. So many times the bank will say, well, I need this, this, and this. And our mindset is immediately that we'll just provide this, this, and this. So the point being, if it supports your request for a loan, by all means include it. Go beyond what the basic requirements of the bank are, because in essence this is a sales job. So if it supports what you're trying to do, by all means include it. Some other thoughts that I'd share with you. To have successful borrower relationships, we need mutual trust and respect on both sides of the desk. And those both need to be earned. And if you buy that concept, you have to recognize that that takes time. And so you want to start relationships up with a long-term orientation. And then another thing that's extremely important to remember is that at the end of the day, both the bank and the borrower have the same long-term objective. And this is one of the most important comments I'll make all evening, and that is that only after-tax dollars can repay principal. And so in other words, what that represents is profit. And obviously, as the borrower, you want to be profitable, and the bank, granting that they want some interest back, but they certainly want the principal back. And so long term, you both have the same objective. Borrower wants to be profitable, bank wants their money back. Another important thing is to get the lender to your operation. All of us make decisions pretty cautiously if we have very limited knowledge. And if we've not been on your site, we have thoughts in our head that represent your particular business. But get them on site, and that'll help greatly. How does a bank examiner influence your bank relationship? And this can get somewhat involved, and we're about out of time, but they can influence your particular line of credit directly. They can give the bank comment in terms of what portion of your loan they may see as representing a asset that they aren't going to allow them to put on their book if, for instance, you were behind in payments. But they can influence your loan directly. Financial ratios. And again, we can only touch on this very, very briefly, but banks will use financial ratios in evaluating your particular loan situation. And in agriculture, a number of years ago, they had a committee come together and develop what they refer to as the Sweet 16 Ag Financial Ratios. And so if you Google those will come up, and there will be definitions of those. And we referenced liquidity early on in this conversation, the current ratio, and we talked about current assets and current liabilities. But here's just an illustration of the current ratio, which is one of the very, very important ratios. And that's simply dividing current farm assets by current farm liabilities. And ideally, you want that ratio to be a 1.5 to a 2, or in other words, it's saying for every dollar you have coming up in liabilities in the next 12 months, you've got $1.50 to $2 to pay it with. And obviously, minimally, it needs to be 1 to 1. Steve, I think, has included, and we have this next slide here, a number of ratios that are available through PFI materials. Is that not so, Steve?
Yep, that's right. This whole chart is taken from the whole farm financial project that we put in the chat box earlier. There's a lot of these ratios are calculated and show examples of how they're used. So that's all right there.
Very good. And there, I think, as I recall, there were 10 ratios shown there, and I think all 10 of those ratios are part of the Sweet 16. But if you just Google the Sweet 16, you'll get gobs and gobs of information as to how they're calculated and how you use those. Ideally, know what those ratios are. When you go in for your bank review annually, have those financial ratios already calculated and be able to explain them or indicate that you understand what they mean in particular. And then it's important to calculate your net worth both as dollars and percentages of total assets. And the reason for that is that that can certainly give you two different pictures. In the past, it was possible that you would go in. When I first started banking in the late 70s, we typically would never calculate net worth as a percentage. And from year to year, it was possible that your net worth would go up as a dollar figure, but decline as a percentage of total assets. And so it's certainly important that you know where
Paul.
you're at in that regard. Yes.
So on this topic, right before we move on, Carl had a question earlier that I think fits in here. Carl asked, do you have a good rule of thumb for the portion of assets that should be liquid? Any idea?
I don't know about necessarily. That'll be dramatically different from the different types of enterprises. As a quick example, and this one would be where livestock are involved. If you're heavily involved in livestock, you'll usually have a big livestock inventory, and especially if you're feeding livestock versus a cow-calf operation, as an example. If you have a feed yard, you're going to have a high degree of assets that are going to show up in the current position, as opposed to perhaps a row crop operation. And then, too, obviously, the time of the year that we take that, again, if we were looking at a row crop operation, if we sold all of last year's crop and we're doing a balance sheet in June, which typically, would not be a typical time to take a row crop operation, but we'd have very little to show as a current asset. So, as a rule that applies across all forms of business, no, I don't know that there is necessarily a set rule. Using that current ratio is more important than, I guess, in my mind, than to assure yourself that you have liquidity, as versus worrying about what percentage of your total assets happen to be in a current position. And hopefully that's helpful. Some additional quick thoughts. Sometimes I think we get too carried away and too complex when we try to do business analysis, financial analysis. And if we think about it in its simplest form, business is production units times the dollars per unit. So in other words, bushels of corn times, yes. Okay, can you hear me now? Are we're on, are we? I'll Steve had asked that I start this slide over regarding additional thoughts. And sometimes I think we are inclined to try and make our analysis too complex. And in its simplest form, business simply is production units times dollars per unit minus our costs equal profit or loss. So if we try to tear the business apart and say, okay, first let's try and analyze our production units. What are we doing good? What are we doing bad? Etc. And then look at all of our marketing activities. What are we doing? I think we make trying to do business analysis more complex than it really needs to be. And so in its simplest form, think of it in this manner. Production units times dollars per unit minus cost equals profit or loss. So in that regard, first of all, just take a yellow pad and put production at the top of it. List everything that's good about your production activity, everything that's bad, and obviously try to address both the good and the bad. Do more of the good, less of the bad. Times dollars per unit, that reflects our marketing activity. So again, just use a yellow pad and mark in the top half of the pad what represents our positive or good things that we feel we're doing in a marketing sense, and then those things that we need to improve. Then in turn, move to our costs and just go down each line item that's involved in your cost of production and analyze each particular line item, what you can do to control that cost or influence it. And this, of course, then in turn will reflect your profit or loss. And then another quick thought, in terms of growing net worth with your balance sheet, try to the degree that you can, recognizing that to be in business, there are certain things you absolutely can't be without. But try to invest in assets that don't depreciate or don't depreciate quickly, if that's possible. So ideally, things that have the opportunity to appreciate in value. Land in particular might be an example there. And then in general, things that have babies or increase in size. So in other words, breeding stock or crops that increase in size over time. So as we finish up here, another quick thought that I would share with you is don't wait too long to see the doctor. And by that I mean simply if you find yourself in financial trouble, go get help. And there's certainly help available. Some on a free basis. SBA has retired executives who will provide services free of charge. Small business development centers. Get a hold of PFI. They may have some helps for you. Extension service, etc., etc. Professionals can help tell you how to do something, or they can do it for you. So those are two approaches to keep in mind if you do go to professional people that are going to charge you. Delegating at some scale, all businesses get too large to the point where we can't simply cover all the tasks ourselves. So when we get to a point where we have to delegate to continue to grow the business, delegate your weaknesses. And then if you're in partnership with spouses, parents, friends, siblings, simply recognize the fact that the relationship of a spouse or a parent or a sibling is a different relationship than a business partner. And you're trying to carry on both of these at the same time. And you act and react differently on the basis of both. And then understand the bell curve. And given a large enough population, everything falls out on a bell curve. And if you're not familiar with the bell curve, it says that there are very few people who are really, really, really good. There are very few people who are really, really, really bad. And the bulk of the people will be in the middle. And the point being that to succeed, you obviously want to be on this end of the bell curve. So, carry on the activities that'll get you there, associate with people that are there, etc. And then by way of closing, Stephen Covey's The 7 Habits of Highly Effective People is a book that's certainly worthy of your reading. But I recall one page in particular, and there were 3 interlocking circles. And the point that Mr. Covey made is that for anything to happen, or in particular to change course, you have to know what to do, you have to know how to do it, and then lastly, you have to want to do it. And today, just as with this webinar, hopefully, But with the internet in particular, with all the knowledge that's available, with all the help that's available from multiples of sources, it's not hard to know or seek out the knowledge to know what to do and to know how to do it. But in my mind, after roughly 40 years in dealing with ag finance, the want to do will probably be the most important ingredient of all. With that, I certainly thank you for the opportunity to spend some time with you. And Steve, have we got some questions that we need to address?
Yeah, thanks a lot, Paul. That was a lot of stuff covered in a short period of time. So, those of you who are listening in, go ahead, please enter your questions in the chat box here. I'm sure there's been a few that that has sparked some curiosity with you. I did get some questions ahead of time from some folks, and I'll start here, Paul, with a question about in regards to building a farm budget. And this is a question from a guy, Jacob, who was asking about basically the reasons to lease equipment versus ownership. So he says, if I have a tractor that's paid for, are the only tractor expenses that I list in the budget the operating expenses of that tractor, like fuel and maintenance, or is there more to it? Basically, why lease versus own, and how do you put that into a budget?
Okay, there are a couple of questions there, really. One has to do with what line item do I enter in a budget? And in responding to that particular question, you enter the things that represent hard dollars. So if your tractor is paid for, you don't have a payment, so we don't need to schedule interest or principal, but you would schedule maintenance and fuel, etc. The second question is, should I lease or own? And you just have to run the math in those respects, and you'll of course have to make a number of assumptions. But one of the things about leases is that if you lease, the total lease payment is deductible as a tax deduction, and sometimes that influences the decision dramatically because that number may be higher than what the government allow you to depreciate that particular item for in a year. And then a second reason is that sometimes lease periods are much shorter than is the allowable depreciation time frame. And so as a result, you can write it off against income tax more quickly. Also, when it comes time to put it on a balance sheet, if you buy an item and finance it, you're going to add the item on the asset side, and you'll show a liability on the for the loan balance on the liability side. And leases typically don't enter into the balance sheet consideration at all because you don't own the item, you're only paying for the use of it. Next question.
Yeah, great. I'm not seeing much activity in the chat box here. I'm sure some folks have questions, but I do have a few more here. Let me move on. There's another question that had to deal with budgets. This on enterprise budgets. So, do you, Paul? We didn't really touch on the concept of opportunity costs. Could you maybe discuss an opportunity costs and how you can add that into an enterprise budget?
Okay. An opportunity cost, by way of example, if we were involved in a livestock operation and also a row crop operation that grew corn, for example, and we also will say had a hog enterprise. If we were doing a hog enterprise, where opportunity costs would come in is what is the alternative use or the alternative opportunity for me to realize income from the corn. So for example, here 3 years ago or so when we had $7 corn, if we could sell the corn for $7 versus feed it to the pig, and we're doing the pig budget, the opportunity cost for that corn then would be $7, and technically that's the value that you would enter into that pork enterprise budget. it's not always that simple, because if you've got a confinement building and you're committed to a hog operation, you can't just arbitrarily say, well, this month I'm going to sell corn and next month I'm going to feed it to pigs. But that's the concept behind opportunity costs. Next question.
Yeah, great. Looks like Greg here in the chat box was asking about QuickBooks. You said QuickBooks is a great resource, and Greg's wondering, he says it's not particularly intuitive just to jump in with QuickBooks and get started. Do you know, is there any easy way to get going with QuickBooks?
Well, there probably isn't any easy way, period. But I would say that QuickBooks has a reputation of being as easy as any of them. And QuickBooks does have various levels. And so depending on what you're trying to do, there's Quicken, which is the lowest level and the most general in concept and the easiest. And then QuickBooks, QuickBooks Pro, etc., etc. But there's QuickBooks for Dummies. And then the other thing that I failed to mention here is that obviously, as we've gone through the course of discussion here this evening, if you're going into any form of business, I just strongly feel that you need to go and take a basic accounting course and a basic finance course. Do it even for non-credit if need be, but it'll just help so immensely. And it is tough to get started, perhaps, using accounting software without some of that background, but it is possible if you're persistent enough.
Great, and maybe we'll do a Farminar topic on getting started with Quicken or QuickBooks someday.
That wouldn't be a bad idea at all. And the other thing I would say about QuickBooks is that there are people who have put tutorials out there, and QuickBooks does come with a whole various menu of different forms of business that'll help you, that are all pre-programmed in to help you with all the various line items, expenses and incomes, etc., basis on what kind of a business you're going into. But there are whole tutorials that have been written on how to use QuickBooks for agricultural purposes. And again, just get online and Google for those.
Thank you, Paul. So switching gears here, I had some questions given to me on the financing part of this talk. And so there was a question from a beginning farmer that was using the Farm Service Agency financing, FSA financing. And the question is, even the FSA requires you to look to other lending agencies for a farmland purchase loan. Do banks and credit agencies want to loan to beginning farmers? Who's doing the best job in Iowa at providing low barrier loans to beginning farmers besides the FSA and the government? Any idea on that?
Well, again, this will vary from bank to bank. Some banks are far more conservative than others. Some banks specifically have programs to try and start beginning farmers. And they may have a given number that they try to start each year, or a given dollar amount that they're willing to expose to beginning farmer loans. But again, it's just a bank by bank situation. I've over time have had opportunity to teach at banking schools that train ag loan officers. And one of the points that I try to make to them is that ideally banks need to think of themselves much like foresters. The guys that are cutting the timber today to produce lumber didn't plant those trees. Somebody before them planted trees. And in the same sense, it's my hope that progressive ag banks in rural Iowa and throughout the U.S. would have a similar attitude, because the people who are the mature operators today probably weren't started by that loan officer that they're dealing with today. They were started in farming by someone else many, many years before. So hopefully we have some banks out there that have that long-term range, and you just have to do your best to find them. Again, you might Google beginning farmer loans in Iowa and just see if there are any banks out there that pop up.
Thank you. So looks like Carl Glansman here has got a question, and I'll read it here, Paul. Would you recommend that a starting farmer pay farm expenses out of a personal income and await harvest income to take reimbursement, or have a farmer borrow expected costs to harvest and hold cash to back up the farming enterprise?
Well, I guess the quick thought that comes to my mind is the magnitude of dollars that are available from personal income. And then looking down the road long range, if you've got idle dollars sitting there and you have the ability to use those dollars and not pay interest, I'd probably go ahead and use those dollars. The one thing you want to keep in mind, obviously, is to have some liquidity. And if you use your own dollars, typically that would imply that you should still have assets that would be available to borrow against, until you got to harvest, if that need happened to come up. But I'm not certain that I'm understanding the question or perhaps answering it in an appropriate manner. But if you've got funds available, I guess I'd be inclined to use them as long as you felt that you still had borrowing capability if you needed it.
I think that about covered it there. We still have some time here for questions. I'm not seeing a whole lot of activity here. Any more questions, folks? We can go back to any slide that might need clarification if you're curious about a topic that was covered kind of briefly earlier in the Farminar.
One of the points that I would make, and I alluded to this earlier, but sometimes we smile, but I tell people you want to remember that lenders are mortals, and in that sense, most of us fear the unknown, and so anything and everything that we can do to get them familiar with ourselves, to show them what we're doing within our operation to manage risk and control risk to the degree that we can, getting them out there to your business so that they firsthand can see physically what's going on. Those are all things that help them get over, fearing the unknown, if you would. And so, don't be bashful about doing more than the minimum bank requirement, because again, it is a sales effort. Any other questions that we can be helpful with?
I was just going to pull up the ratio slide again, because I thought there were some interesting ratios here, and I thought this might spark some questions just about the different uses and the different numbers that you can use to calculate these different ratios and for what reasons.
Yeah, in general, the ratios will tend to fall into groupings, and maybe I didn't go through each of these, and I don't know that we necessarily have time to go through them one by one or want to, but usually ratios will deal with the percentage of the business that you own, and oftentimes there are three ratios that they'll use in that regard. They'll divide the net worth by the total assets. They may divide the net worth by debt, or they may divide I'm tangled up in my mind here, but at any rate, there are three ratios that in essence all three tell us the same thing. So, those are going to tell you something about leverage. Current ratio is going to reflect liquidity. And then usually there may be several ratios that'll be directed at return on investment, return on net worth, in other words, your dollars in the business, return on the total dollars used in the business, ratios that will define how many times your assets are being turned over in terms of the total sales that you generate in a year. So again, a grouping there. And then lenders are also interested in ratios that give them coverage. And by that term, they mean, for example, if you project your cash flow needing, we'll say, $125,000 to meet all of your expenses plus pay your principal that's scheduled for the year, to the degree that you have funds beyond that 125 expressed as a percentage, that gives them some sense of coverage. And so, for instance, if it took $100 to meet all your obligations, ideally they'd probably feel reasonably comfortable at $125 or more being projected in your cash flow projection. Obviously, they always like some margin. Earlier too, we talked about the current ratio, and I said that it reflected current assets being divided by current liabilities, and that would imply that minimally we want it to be 1-to-1, or in other words, for every dollar we have to come up with, we got $1 to pay it with. And you might think that 1-to-1 would let you get by, but in reality that typically is not the case just because of timing. Because, for instance, if it happened to be a crop, if it's not mature yet, it may have a value representing $1, but if you had to pay all your bills, if you had a machinery note that was due in July, and you've got corn out there that's, representing a value, but it's obviously not mature. So that's where you get into wanting your current ratio ideally to be more than 1-to-1, so that you have enough excess funds that it makes up for those issues with timing.
Right, great example. Yeah, so it looks like we have exhausted the questions in here, so maybe this is just a good time to wrap it up then. Thanks for everybody for tuning in here, and a huge thanks to Paul for taking the time to talk with us tonight and share his knowledge. So again, we referenced a lot of PFI resources in the chat box here that you can turn to for some help. Plug in with our beginning farmer programs. We always try and focus on farm financials because that's something that we think is real important to have a healthy, successful farm business. So come to our events and get involved, and we can help you through this. So yeah, thanks for tuning in, and thanks, Paul.
Thank you for the opportunity.